Welcome, movers and shakers. I am your host and realtor, Janitha N. Moore. Today we have Loan Officer Barbie, Deanna Turner, joining to help us dispel some myths about the mortgage process. Welcome, Deanna.
Hey, thank you. Thank you so much for inviting me.
Thank you for joining me today. Tell me more about yourself and how long you've been doing it.
Okay, well, I started in 1998, so I've been in the business now for about 21 years, and I have probably worked with somebody that falls into all of the buckets. I've worked with people that are first-time buyers, move-up buyers, seniors that are looking to downsize. I've worked with new construction, so I've been an on-site, referral as far as a preferred lender situation, condos, townhouses, single-family homes. I've done pretty much everything. And working at Loan Depot, we offer pretty much everything. So the only loans that I don't believe that we have an offering for would be anything slated as commercial or land. So everything in between, we do.
I want you to help me with buyers. I want them to stop wondering about what it would take to purchase a home and to take the leap. Let's talk more about income, credit, down payments, and debt.
Okay. Well, really what we're looking for as a lender, of course we're going to look at your credit, so your credit score does matter, but I don't think it matters as much as I think the consumers think it matters. There are consumers out there that think that the interest rate that they get is directly related to their credit score and only that, and that's not true because there's some other factors that weigh into where your interest rate is going to be versus someone else's interest rate. So credit is important. Debt to income, a lot of people have some misconceptions about how we arrive at debt to income and what that ratio really means. And then as far as the things we're looking at that would make you an eligible candidate to borrow. So we want to make sure that you've got stable employment. It doesn't matter if you're self-employed or not, but we're really looking for you to have stable employment, which means specifically we hope that you've got 2 years of employment that's been steady with no gaps and preferably at the same job. Or if it's not at the same job, it's within the same field and maybe you've just transitioned from one job to another. But it doesn't mean that if you just had a change of employment that you have to be on this job for 2 years. So you could have just switched, been at this current job for 3 months, but you were at your last job for 3 years. That's fine. That's completely fine. When it comes to credit, there are different things that you're going to hear in the market coming from different lenders, and that's unfortunate, but it's really because of the risk involved with lending and the landscape that we're in right now. So you have big lenders, medium lenders, and you may have smaller lenders, and some of the smaller lenders might be working on a warehouse line of money that they're getting from a much bigger investor, so say like a Wells Fargo. So you have XYZ mortgage company or XYZ broker. They basically have to sell a loan to this investor. So they're gonna underwrite and approve the loan based upon the guidelines that that investor has. So that investor, let's just say it's Wells Fargo, just as an example, you're doing a conventional loan. Well, conventional loan standards might be that, okay, you could go down to, a 620 score. Well, it may very well be that for that investor, Wells Fargo, to buy the loan from that broker, that broker not only has to have a credit score of 620, but maybe the ratio has to be a lot lower than the norm. Or maybe they need to have reserves in the bank after the down payment of a certain number of monthly payments or the equivalent thereof. So those are things that kind of play into what maybe that lender can offer. And that's also because that investor is in the marketplace as well on the retail side. Wells Fargo doesn't want to compete against itself. They're always going to go deeper for a loan that they originate for themselves as opposed to one that's being sold to them by another company. Go ahead.
So break it down for us. Do buyers need 20% for a down payment?
No, that's a misconception. It used to be years ago that the only way you were going to get a mortgage is if you had 20% to put down, because we didn't have the mortgage products that we have today available 20, 30, 40 years ago. When I first got into the business, interest rates were 8%, 9%, and you didn't have the complexity of different offerings we have now. So yeah, a lot of people thought put down 20%. You can get a loan with 3%, 3.5%, or 5%. In some cases, you can even get down payment assistance, or you can get 100%. But, you know, those all carry different interest rates, and they all carry different qualifications as far as ratios, and sometimes there's income that you can't exceed. So it just really depends on your individual situation.
So no.
No.
The answer is
no. No.
They need to hear that. That is so important, because that has been a challenge for me when I meet new first-time home buyers, and they are fearful that they don't have enough money because they haven't saved 20%. And I go in length in my discussion with them that that used to be, but not now. You do not need to have 20% to start the process for a mortgage loan.
Along with that, let me just dispel another myth that you don't have to have the perfect or elite credit score. You don't have to have a 720 or a 700 or a 740. Don't have to have that. So, you know, there's a lot of old wives' tale fables, if you will, out there about the mortgage industry. There's a lot of product out there available to help people. And so I'm just a solution-oriented lender, and we're just going to meet you where you're at. In most cases, you probably think that your situation is worse than it really is, but because you've been listening to what I call the white noise, where you've got all these people, your mom, your dad, uncle, aunt, friend, coworker, telling you stuff in your ear about what they did when they bought their house, things have changed. And so because things are always kind of evolving, you need to get information that's relative to your circumstances and what is current for what we're going through in the market today.
And you have helped me with my first-time home buyers with down payment assistance programs, and they've been pretty successful. They closed their transaction, they got their keys, they moved in. In your opinion, do you think the benefit of the down payment assistance programs is the juice worth the squeeze? Do you follow what I'm saying? And this is totally your opinion.
Okay.
I don't want to put you in any bad position, but people need to understand, is there free money or no free money?
There's no such thing as free money. Okay? There is no such thing as free money. I cannot say that strongly enough. There is always going to be a give and a get. Okay, so I oftentimes have to, in my discussions with first-time buyers in particular, all they've heard is the white noise in the background saying, oh, girl, there's a program out there, you can get this money. But what they don't understand is there may be some limitations on the money. Okay, so oftentimes with down payment assistance, the agency that's providing the down payment assistance, they have their own set of guidelines for how you qualify for that money that has nothing to do with the lender. Okay, so the lender may be working in collaboration with them, but it's a two-step process. I have to qualify you for the loan. The loan has to be a loan that's compatible with their program, but then I have to qualify you to make sure you qualify for their assistance. And their qualifications are probably going to be a little bit more strict. It's usually credit score, debt to income, in some cases the location of the property, and in many cases they don't want you to be sitting on a whole bunch of your own money, because why do you need their money if you have your own? So there's some things we need to look at there. I personally feel that down payment assistance programs are good, and statistically I read something today that kind of demystifies the whole thing about, well, if you're getting down payment assistance, you're going to have a higher default rate on your loan. That's not true. That is not true. People getting down payment assistance do not have a higher default rate. They are just as responsible in paying for their mortgages, and because those agencies have higher standards for qualifying, everybody's not going to get their money. But the ones that do, they're going to be vetted through this process to make sure that they have the ability to repay. Now, one thing to be clear about is that oftentimes the agency that's giving the money, they may set their own interest rate for that money. They may have some sort of a period where you have to live in the house for so many years.
Yeah.
The purpose of the programs
This is
to
the
help.
squeeze.
Yeah, this is the squeeze part, but really you got to think about it. Okay, if you can get $5,000, $7,500, $10,000, but it means that you might have to commit to living in a house for so many years. In most cases, those programs have a program that says, or a guideline, that says you need to live in the house for 10 years. Well, if you got $10,000 and you don't want to ever have to repay that $10,000 back, the expectation is you live in the house for 10 years and then that is waived. It's forgiven and you don't have anything to repay. But if you move or you sell your house sooner, then there is a percentage of the money that you will have to repay because you did not keep your commitment to stay in the house for that time. So it's called an affordability period. And it's not something that you have to pay all of it out of your pocket. They just will find out how much time you've had in the house and what percentage of ownership time that was for their affordability period. And just like you have a payoff on your mortgage, they will count that as a payoff and add it to your mortgage when you sell the house. They just pay off everything. If you're going to make money, then you'll make money, and whatever you make is yours. So I think it can be the perfect way for someone that doesn't have the discretionary income to save money to be able to get into and afford a home. The interest rates aren't that high, but you got to look at how much are you getting versus what the commitment's going to be. Are you going to pay a slightly higher interest rate? Because in some cases you will. How long would you have to live in the house until you have to think about possible repayment? Is there any kind of a penalty? In most cases there aren't. But I think they're all good things. I think the thing that I struggle with is that there are some people out there that think that their home buying is dependent on getting down payment assistance and they haven't saved up any money of their own. There is some money that you have to have for the process. Every one of those programs has a minimum investment that the buyer has to make. It could be $1,000, it could be $1,500.
Say it again.
Every one of those programs has a minimum investment that the borrower has to make. It could be $1,000 or it could be $1,500. But in addition to that, please be clear, you have to have money for the process, period. So you better have money for earnest money. Technically, earnest money should be 1% of the sales price of the house.
Yes.
If you're in a situation with multiple offers and you're in a seller's market as we're in now, you might need to have more because you're trying to make your offer stand out for that seller to say, I'll take it. So you might need to put more down to get that offer. So know that you're going to need $1,000, $1,500, $2,000 or whatever for your earnest money. Know that you're going to need an inspection that protects your interest in this house. You want to know if the house has problems.
Yeah.
The seller may never have lived in the house. If they're an investor, they can't tell you the history of the house. So you need to know.
You have to have some savings.
You gotta have to have some money.
Take care of the expenses.
Yes, ma'am.
For the process.
Exactly. And you gotta have money for an appraisal. Lastly, as a lender, I don't want to set anybody up to fail. It really troubles me when I have a buyer that is so limited in what they have to where they're going to deplete themselves to buy this house. They have no more money left in the bank. Okay? That worries me a great deal. I don't want to set anybody up to fail. So it's important, in my estimation, that regardless of any desire you have to explore options with down payment assistance, that you have some of your own money. Savings, checking, you can get a gift from family members, you have a 401k. These are all other sources that you can use for down payment, and don't let whether you get down payment be the driving decision as to whether or not you buy a home, because you need to look at what's your timing with the market. Right now, interest rates are as low as they're probably going to get. Interest rates were decreased yesterday by a quarter. So the base rate that members buy their money from the Federal Reserve Bank was reduced by 0.25%. So that means those member banks, which are all these banks on the street, now they've got money coming to them cheaper through the Fed so they can offer this money cheaper to you. Cheaper money means your budget goes further. What you can afford to spend means you can now buy more house for that same dollar than you could the day before yesterday. You need to look at that and think about, okay, what is my timing with my desire to buy a house? So sometimes waiting is not the option either. So we need to look at everything as a whole to see, does this work now? Can I get down payment assistance, and it's a good deal for me now? What are the costs associated with the down payment assistance? If you're only going to get $5,000, but you're going to have your closing costs increased by $3,000, is it worth it to get the $5,000? In my head, that's only a $2,000 net difference to you. Is it worth it? That's what I have to do with you as a lender, is kind of point these things out so that you don't get so distracted with the fact that you're getting the money. You're getting it, but at what cost? If it makes sense, do it. If it doesn't, let's find another option.
And the realtor works closely with both of you to figure out what is a best strategy to get the buyer into the home. And I'm so glad that you worked with me on a couple deals that my clients benefited from some of these down payment assistance.
You gotta have a strategy because the programs are different. And depending on the program, then what you have to do in representing them and any offer that you're making, that's going to be different. So, some programs don't give you anything but down payment assistance. So people seem to forget that you have closing costs associated with a loan.
Absolutely.
And those closing costs are the buyers. The seller doesn't have to pay any closing costs. They are not obligated. So it's like someone asked me the other day, well, if you were selling your house, would you pay closing costs? And my first response is, well, as the seller, why should I pay you to buy my house? And that's how a lot of sellers look at closing costs and whether or not they should pay closing costs. So as a realtor, if we have a strategy between you and me and your buyer,
right,
and this person knows they can get this program for assistance with the down payment, but we don't have enough to cover those closing costs. Now we got to look at, well, what does that buyer have that they can contribute? And then what would that potentially leave that you would need to negotiate on their behalf for the seller to kick in? And sometimes it's a matter of maybe you give them a full price offer, and in lieu of asking them to reduce the price, you ask for closing costs.
Well, don't show our hand. You have to give us a call so that we can put this plan into effect, because we have the strategy. Deanna has worked with me, and we to a successful end. So we're just talking about, there's options out there for you that will help you get your home, and do not be dismayed by down payments and credit when you have somebody that can help you understand where you are in the process and offer you some real solutions. So you were saying that credit score matter. How low of a credit score can people have to start the process? How low is too low, and what makes me disqualified or the buyer disqualified?
Okay, so in general, a 580 credit score is what you need for FHA and VA.
Okay.
And a 620 is typically what you need for conventional loans and USDA.
Okay.
That's pretty much where you're going to start.
So 580.
580.
580.
Now you will hear that there are some lenders out there that will say, oh, nope, you need a 620, you need a 600, and it's going to be a different number. So the reason why that is because sometimes those lenders are selling those loans to another investor. Remember what I said before about an overlay? So for example, FHA says you can go down to 520, okay? But the lower the credit score, the higher the risk is to the lender for default on the loan. So we go down to 580. We feel that that is a very safe number where we can still offer that loan with a minimum of 3.5% down.
Okay.
But once you go under 580, we can go down to 520 if you put down 10%. So a really good example of something is sometimes you have somebody that had a credit event, something that happened that happened that they couldn't control, and it's caused their credit scores to be lower, but they actually have a good credit profile. So, for example, maybe you have a parent that co-signed on a car loan for a child. The child didn't pay as agreed, and the car was repossessed. Well, because the parent co-signed, that repossession affects their credit. The rest of their credit is beautiful. They might have had 600-700 scores, but now this repossession has dropped their score significantly. So now the score is under the threshold of the 580. That person is the perfect example of how you can actually work with them if they have down payment to put down what they need to still get an FHA loan. There are a lot of banks that would just turn them away. A lot of companies don't have an option. So that's something I'm proud to say that we can do. I have a loan recently where that was the situation. Parents had done just that. They had a home that they needed to sell. So they sold the home, used the proceeds from that home to buy the next home, put their 10% down, they kept the difference, got their new house. Their scores were under 580, so that works. One thing to be certain, understand also, is that when you start getting into scores that are under 620 for FHA and VA, you're going to have a manually underwritten loan. It is not going to be a loan where we send it through Desktop Underwriter or Loan Prospector, which are the two underwriting engines that all lenders use for automated underwriting approval. So when you start going under 620, that means that your ratios really have to be more in line with what the guidelines are. That they're really looking at those individual trade lines on the credit report to make sure you don't have a whole lot of late payments beyond, say, 30 days late. Maybe you have a 30-day late, but you don't have a whole bunch of them, or you don't have a whole bunch of 90 days and 60 days. You don't have any real major credit events. But we're going to take a look at that, and we can work with manual underwriting. Some companies will say they can't do a score below 620 because they don't do manual underwriting. So they're not explaining why they can't do it. They just say, nope, can't offer it at 620. So that's just a little bit of a difference between lenders that you need to know if you're in that situation. Credit monitoring also. You should do some credit monitoring just so you have an idea of what your credit looks like, but don't count those scores as being very accurate. It's just an idea of where you are. One score might be accurate, the other two may not be. So in the end, the lender is going to have to look at their own credit reports to make a decision, but at least you have an idea of where you're starting from before you start with them.
So what I hear you saying is people they live their lives, things happen, and do not be discouraged because you have a blemish or have had some challenges. Go ahead and submit an application if you really want to move forward so that you can take a deeper dive and investigate and look at their credit file and history of things to see if you can offer a solution.
Absolutely. Because sometimes people are harder on themselves. Again, that white noise. Okay, so you had a repo.
Yeah.
What happened? You had some medical collections. What happened? You had a late payment. What happened?
Bankruptcy.
Okay.
7 years ago.
Right. So there are things that, I'll be the first to say, I bought a house, my first house, I had no money saved up. I had blemishes on my credit from college, but somebody took the time to show me a way to get this to work. Okay, so I was able to buy my first house because that person showed me how to do that. I really try my best to emulate that person when I'm talking to other people. I don't have perfect credit to this day. Life happens.
Right.
Okay?
Right.
But I don't sit in judgment of anybody's situation either. So it's all about meeting them where they're at, and then taking a look at the situation objectively, not with any judgment, but objectively. And if we can't do something right now, that doesn't mean that without a plan, we can't do something later. So a dream deferred is not a dream denied. It just means you have a little homework. And Iyanla Van Zant says all the time, you have to do your work. So if you have to do your work to get what you want, we can work together. If it's not meant for you to have it right now, that doesn't mean it's not going to happen later. So the best thing is work with a competent realtor, number one, please. A competent realtor is going to have a very good, competent loan officer, and together they're going to guide you. It's like when you go to a doctor. doctor has a great nurse. Okay, if you're going to a surgeon, please understand they're going to have a number two.
Right.
They don't do everything by themselves. So she's a professional. I'm a professional. Let the professionals advise you as to what to do. The more you listen to what other people who have not looked at your situation are saying about something that they don't know anything about, it's like, why would you even put any stock into what they're saying? If someone says, well, my credit score was this, that, and the third, and I did this, that, and the third, and I got this, believe me, they're not telling you the whole story. So don't compare your situation to anybody else's, because your situation is unique and it deserves to be reviewed and discussed. And we need to come up with a plan. What you think is bad may not be as bad as you think. But let me be the one to tell you, don't assume anything, because you will stand in your own way.
Absolutely. And I just remember having full disclosure with you about one of my clients that I brought to you who had some concerns about not being perfect or seemingly this profile that was told that she needed to be. And your famous last words were, well, I'm either going to give you a budget or I'm going to give you a plan. Either way, we're going to figure this out.
We're going to work it out.
We're going to work it out. And we did. And so, and my client was so grateful for those famous last words, because it was comforting to know that you were solution driven. And I was teamed up with somebody that was willing to not just try to dismiss her because they only want to work with a certain clientele and not help them realize their dreams of home ownership. So we really appreciate you willing to roll up your sleeve, because you're right, a lot of lenders do not roll up their sleeve and want to deal with the people that has had a full, exciting life that has some history and some texture to it. So, famous last words. You either get a plan or you get a budget. So we're gonna move to the next question.
Okay.
Is income the sole factor at arriving at a budget for these buyers?
No. One of the very first questions I'm always going to ask is, what is your maximum desired monthly payment? It is about what you can afford to pay. And yes, income is going to be a part of it in the end, but in the beginning, I want to know what your goals are, and I want to know what your plan is for yourself, because my goal is to get you to where you want to be. I've had people ask me, well, I just want to know what I qualify for. I just want to know what I'm approved for. I just want to know what I'm eligible for. And that's great, but guess what? It doesn't make sense for any lender to qualify you based upon what you tell them that you make, and then say, oh, well, you qualify for a $300,000 home, but never had enough respect for you to ask you what you wanted to pay. Because you got to respect the budget. If they tell me they want to pay $1,400 a month, I don't care if they qualify for $300,000 on paper because they make so much. They tell me, oh, I make this much. Okay, that's great. But if they don't want to pay $2,000 or $2,100, which is what a $300,000 home is, why would I come back and say you can qualify for $300,000? I'm going to respect the budget, and I'm going to meet you where you are, and based upon that number, I'm going to work towards qualifying you and letting you know what that's equivalent to in dollars. And then once you get out there and start looking, if that works for you, great. I'll let you know if you have some wiggle room because of your income to increase the price range if you're willing to increase your budget. But your budget is going to dictate the numbers. Now, one thing about income that people forget about is that there's another component that we have to look at, which is your debts. Okay, it's your monthly obligations. And one thing that I think a lot of consumers get confused about is they think is how much they owe. It's not about how much you owe. I don't care if the balance on that credit card is $10,000. If your obligation is $200 a month, I'm looking at the $200 a month, because what I'm looking at is what are the bills that you are obligated to pay, what's the monthly payment, as it's reported on your credit report. So I don't care about stuff I can't see. You might have that car and you have to pay insurance. The insurance payment doesn't show up on your credit report, so that does not go into my calculation. I'm looking at what's on the credit report, what's the minimum payment that's required to satisfy that obligation every month. I'm going to take that total and I'm going to divide that by your gross monthly income. And that's how I come up with your debt to income ratio. That ratio is going to determine what kind of loan I might be able to offer you. So the magic number or the golden rule is 43%. Okay, conventional loans, they really want you to be at 41. But your VA and your FHA and your USDA, 43% is good. Is there wiggle room to go above that? Yes, there is. But that depends on the rest of the file. How strong is the credit? How much do you have in the bank for assets? You know, how long have you been on your job? How long have you been renting? What are you paying for rent compared to what your projected payment's gonna be? Are you getting ready to double what you were paying before? Triple what you were paying before? These are all things that we have to look at because that's the way an underwriter looks at it. They're looking at risk. So that all comes into the picture later. So income is a consideration because you can have two people making the same thing. One person may have no debts. The other person may have other debt. They make the same amount, but they won't qualify for the same amount. They won't qualify for the same house. So you can't just look at income alone.
So you're not just only respecting budgets, you're respecting somebody's time. Because if you don't have the money to afford that home, you're gonna tell us up front, no ma'am, no ma'am, no ma'am. So you do not tell them that they can afford a $300,000 home if they don't want to pay a $2,000 mortgage.
Absolutely.
So that's a waste of everyone's time. If you find out in the beginning that they don't want to pay $2,000 a month, so what do you want to pay?
Exactly.
And I think that is a great approach to finding out where you need to start and most importantly where they need to start. I love it. I really appreciate it. And you mentioned 43% being the magic number of it for the ratio. Let's be clear, whose number is that? Is that a government guideline? Is that Deanna's guideline?
That is a guideline with regards to Fannie Mae, Freddie Mac, and your FHA, VA, USD loan. That's usually what we all are looking for. That right there is kind of like the secret sauce. 43% debt to income means you should be able to qualify for any of these loans across the board. Any of those loans, okay? You might be a little bit higher than where they would want you to be for a conventional because they really want you to be around 41%, but again, there's a little bit of wiggle room. So if you're at 41.01, don't think that you can't get a conventional loan. If you're at 45% and you're just over 43, don't think you can't get, in some cases, a conventional loan or a FHA or VA loan. It really is a matter of the gray area at that point and having a little bit of discretion, okay? So the better the application, meaning you've got someone that has solid employment, you've got someone that has a little bit of money of their own in the bank, maybe they have a 401k that they can't touch, that's fine, you know, but they're a pretty stable person, they have relatively decent credit, then that works all day, every day, across the board for all of those loans, provided they have the credit score that they need to have for eligibility.
Should new buyers consider the rehab loan?
Absolutely.
Because they have all of these projects or homes that are solid construction but need some renovation.
Absolutely.
I don't think they understand that that is an opportunity for them. I've been working diligently at helping them see the vision that there is a loan product out there, that there are professional experts like yourself that can help them with that product to take it home and make it their own. Can you speak to a little?
I love the renovation loan. I had this conversation just last night because I think that in this market, people have to be real. First of all, everybody watches HGTV. Everybody likes the Property Brothers. Everybody's a rehab addict. House hunters and all of that stuff. And it looks beautiful and it looks simple and it looks easy. Okay? But people don't have a real understanding of how much a rehab is or how much time it can potentially take. But I think that because they see all these high-end finishes and this, that, and the other, and they love how things look, that people want those things for themselves. And oftentimes the best way to get it is if they can do it themselves, but people don't want to take a separate loan. And people don't necessarily have a nest egg of money to be able to pay for it out of their pocket. So what the renovation loan allows you to do is it allows you to acquire the property and build in on top of that the cost of the renovations. So for example, sometimes you have a house that has awesome bones. It's a great solid house. It might be 4 sides brick. It might be an older home in a mature community. You know, all these things. You just love, love, love this house. It has great bones. But maybe it still has an avocado green kitchen. Maybe it has pink and black tile in the bathroom. Maybe it's got some wood paneling on the walls.
Those low toilets.
Exactly. So maybe cosmetically, it has a bit of work that needs to be done, and you're looking at it like, oh my God, this house has so much potential. That loan is the perfect loan, because if you're willing to put a little sweat equity into it, you can buy the house, and then you can hire your own general contractor to do the things that you want to do to that house to make it yours. So I personally have done a renovation. I did not do a renovation loan. My situation is a little bit different, and I paid to have stuff done. Ouch. Okay. Every time I turned around, I was like, ooh, this is going out, this is going out, this is going out. So the key with this is this. FHA has a product called 203K. There is also its counterpart for conventional loans. Literally, if you wanted to buy a house, let's say you found this house and you got a deal on this house, you could get this house for $150,000. And it's been on the market a long time, and it's in an area where the houses are going for $220 and $230. And you're like, oh, I can buy this house, but it needs this. Okay, well, what does it need? And how much is it gonna cost? Okay, it might cost $50,000 to do everything that you wanna do. So that means you can buy the house for $150, and you can add the $50 on top. So now you have a loan for $200,000, right? That's what you need. Well, on this product, you can put down 3.5% on the $200,000, okay? And then all the renovation cost is built into the loan. So you buy the house, you get your own general contractor, your contractor, and you have worked out every little thing that you want done in this house.
With your realtor.
A time frame. Yeah, well, of course, your realtor is still involved, okay?
Very much so.
Your realtor is going to have to negotiate the deal on this house, and your realtor is probably going to be keeping tabs on everything too.
Yes.
Okay? But in the end, when I say it's easy breezy, it is. As it is with all of these, this process can be as easy as you make it, okay? If you make it difficult for yourself, it can be more difficult. But literally, you can find the house, you can take the price of that house, you can add the cost of your renovations, and the total is what you're going to be coming to me for, at which point your down payment is going to be 3.5% or 5% of what the total cost of this project is going to be. You close, and then that general contractor has said, oh, it's going to take me 10 weeks to do this, and it's going to take me, 3 phases to do this. So phase 1, we do this. Phase 2, we do that. Phase 3, we do this. And as they do this, the lender is going to give them some money to do that phase. And then your realtor and the inspector for that lender are going to go back out and look at that to make sure it was done right. And you're going to sign off on it and say, okay, I'm happy with what they've done. Let's go to phase 2. And then you're going to do the same thing at phase 2. And then you're going to do the same thing at phase 3. And then when you're finished, you're done, you can move in, because sometimes people don't want to live in what I would say is a war zone, because there's a whole bunch of dust and all kinds of stuff going on. Depending on what you're doing, you may decide to move in. If they're just doing a kitchen, You can still live in your bedrooms and have access to the rest of the house. You just don't have a functional kitchen for so many weeks. But depending to the degree of the project, that's going to determine whether or not you want to live in the house at the time. You can even build in a few monthly payments so that, for example, the gentleman that I was talking to last night, he doesn't have to be out of his house that they're renting until June. He wants to start his buying process in January. So literally, if he finds a house in January and he closes in February, he still has 4 months left on his lease. But he's going to take those 4 months to have all the work done on the house that he's closing on. So he's going to stay in the house that he's leasing until the end of his lease period. He's going to use those 4 months for his general contractor to complete the whole build out of everything that he wants to do. But you've got 4 months where there's going to be some payments that come due on that mortgage on that new house that he just closed. So we're going to build in those monthly mortgages, those monthly mortgage payments into the loan. That way it services itself. So now he's not paying rent to stay where he is while the work's getting done and paying a mortgage on top of it.
Don't give all the gifts away, Deanna.
Well, I'm just saying.
You are so knowledgeable. I know you can go on and on about these solutions that people think are problems, but
they're not.
They are not.
They're not.
They are not. Do you have any final thoughts for us today on income, credit, down payments, and debts as it relates to taking a leap forward and to buying a home?
You know what? I don't want to say take a leap, because sometimes people think that means that you're just jumping off a bridge, you're jumping off the highest and tallest. It's really just taking, I'm not going to say a leap. Let's just say you're believing in yourself, okay? Because I strongly believe what God has for you is for you.
And believing in your team.
And God, there you go. And God's going to put people in your way to make it possible. And you just have to trust that these people are professionals and we know what we're doing. We're not going to waste your time. We're not going to waste our time. But you just have to have enough belief in yourself. And I don't mean I'm going to pray on it and pray on it. I mean, sometimes something can't happen right now. But again, if you're willing to do the work to get to where you need to be, we can get you ultimately to your goal. So take a chance on yourself. Why not? You know what you're capable of. Let's talk about it and let's see what we can do to make a plan. And then if you execute the plan, then you'll be that homeowner. And it doesn't matter if it's a renovation loan or it's a first-time buyer situation, you've got a credit situation, whatever it is. You need to at least have the conversation and see what's possible. Because when you don't even have the conversation, you're blocking your own blessing.
Thank you so much. I really appreciate working with you. You have been very helpful with every closing that I've had with you. I appreciate your business.
Thank you. I appreciate the referrals. We're a team.
Yes.
Teamwork makes the dream work.
Thank you so much.
You're welcome.